Could interest rate cuts be just around the corner? The country's largest bank, CBA, are now predicting that interest rate cuts could be 90 days away. We've been waiting a long time for this, and it may finally be here. In the past month alone, many major banks have begun cutting their fixed rates in anticipation of rate cuts. Let's preface this. Economists have been wrong about interest rate cuts before and pushing it back further and further. And CBA are sticking their neck out saying that rate cuts are coming this year, while other economists are suggesting it'll be early next year. In this video, I'm going to go through the CBA story about the Australian economy. We're going to go through the struggling household sector and why CBA are pointing out the pain that Australian households are feeling. I'm going to go through the inflation story in Australia and why CBA are suggesting inflation's on the way down and we don't even know about it yet. And lastly, we're going to go through the employment story and the labour market. Combining all this together, CBA think that the Reserve Bank of Australia are about to perform a major backflip and go from talking tough on interest rates to cutting them inside 90 days. If you're interested in my thoughts, definitely keep watching. Hi, I'm Reedham Syed, founder of Confidence Finance, ex-Treasury economist, and now I work with thousands of property investors all across Australia, helping them build, grow, and scale their property portfolios. Okay, so the first part to this story is the struggling Australian household. Check this chart out. It shows Australia moving backwards per person or per family every single quarter for nearly 2 years now. And the last quarter has been pretty aggressive, the worst we have seen it. This is off the latest GDP report card that came out a couple weeks ago that shows how the Australian economy is performing through to June 2024. It shows that we're struggling. We are spending less and less per household. In fact, real spending per household went backwards that quarter by 0.2%. The annual growth figure only grew by 0.5%, less than half the RBA's expectation. Meanwhile, when you compare it to the United States here, you can see the United States households, they're kind of feeling a different story altogether. They are spending more per household and getting in a little bit more every single quarter and improving their living standards as a result. It's a different story in Australia. It shows that interest rates are working and really hurting the household sector of Australia. You can position this one step further and look at businesses too. Now, if you combine this two, the household sector, consumption makes up roughly 60% of the Australian economy. And then when you add in business investment, you get another 20%. So combining these two, you get the majority of the Australian economy and how the Australian economy is performing. If these two sectors perform poorly, the Australian economy does too. This is a chart of business conditions in Australia as well. Now, there's a whole range of metrics that CBA use here. You can see trading conditions, employment conditions, profitability, and forward orders. But what you can notice in every single forward-looking indicator is it's going down, 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 down. What that suggests is businesses are also struggling. Yes, it's reporting season right now, and yes, businesses are making profits, but the level of profit growth that they have is coming down, and when businesses stop growing their profits, they begin finding ways to go and get that profit, and that means cutting back workers, and more importantly for the Reserve Bank and what they want to see, it means that they have pressure on them and reduces their ability to increase prices. And this is where we get to the second part of the story, inflation. This is the most interesting part of CBA's research. If we go through a number of charts here that they produced on inflation, you can see that the inflation story that's happening is inflation's been coming down in Australia, but their predictions, their lead data predictions that they have are suggesting that inflation's going to come down a bit quicker than the RBA expect. They've back-modeled what the RBA expect for the next quarterly data release on the 31st of October. Coming out pretty soon, one of the key data pieces of information that will trigger any potential rate cuts, they think an 0.8% print is coming to life then. That's the RBA expectation. CBA think we're going to come in below that 0.8%, and that is the number one reason why they think the RBA will have enough data there, enough of a story for them to backflip on their story of potential rate rises and we're not going to cut interest rates to hey, hang on, we got it wrong. We need to cut interest rates because the Australian economy is slowing down and inflation is going to slow down quicker than we expect, allowing us to provide some households a little bit of relief just before Christmas. So one of the latest inflation pulses is actually from the Melbourne Institute. This chart shows the Melbourne Institute's lead data on inflation and how trimmed mean inflation correlates with it. Now, there are some deviations, but when you look at this chart, you can pretty clearly see trimmed mean inflation, the number the RBA look at, the key number that they're looking at, and the Melbourne Institute gauge, they just follow each other. And the Melbourne Institute gauge is more timely. It comes out sooner than 31st of October and gives you a little bit of a read. What is that 31st of October print going to show? And you could see this data set. That inflation print, that inflation gauge is very, very soft. It is nosediving really, really low, and it's in the middle of the RBA's band right now, and it might even continue to keep going down. There's a number of reasons for that. When you break it down a little bit and you look at a few different components of the inflation index and what is driving the Melbourne Institute's forward-looking downward pressures on inflation, it is home building inflation and rents. This makes up nearly a quarter of the CPI basket that the RBA are looking at. And this quarter is coming down dramatically. We have some of the slowest building inflation rates that we've seen on record. It's here in the charts, it's down, 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 back to where we need it to be. And also forward-looking indicators on rents, wow, they are dire. Rents have gone up nearly 40% since COVID hit our shores. And it's been in double-digit territory just about in every capital. Here in Sydney, it's been really, really rough, and it's way worse out on the western side of Australia in Perth and in Adelaide too. But that story is changing dramatically. Sydney rents are now falling. Forward-looking indicators for rents are now falling. They are nosediving. When you combine this, home building inflation and rents, you have a pretty powerful disinflationary gauge hitting our inflation figures soon. On top of that, you have petrol prices. I went to the Bowser the other day and it was $1.60 something. I was shocked. I was like used to paying $2 and now it's $1.60. That's like a 25% difference in petrol prices kicking in. Now, this doesn't really feed into trimmed mean inflation, but it does showcase that pressures on fuel and other price pressures are coming down, and that's going to pick up in new inflation data soon. With inflation slowing and the Australian economy slowing, the last piece that the RBA need to see before they feel comfortable cutting rates is a pretty ugly one. They need to see unemployment, the labour market, they need to see it weaken a little bit more. Yes, unemployment has gone up from 3.5% to about 4.2% today. But labour market conditions are still pretty strong in Australia. It does show that interest rates are working to slow the economy down, but it hasn't really hit the jobs market all that much yet. And the jobs market is performing very much like the RBA expect. Now, if they have inflation coming down a little bit quicker than they expect, the economy slowing a little bit faster than they expect, and unemployment remaining the same, that might not be enough to bring forward rate cut. But if in the next month or two, unemployment prints show that the labour force is weakening a little bit faster than expected, then the RBA will have everything that they need to bring forward those rate cuts from 2025 to 2024 and completely backflip on everything that they've been saying this month and change their tune and be like, hang on, the economy's slowing down, it's time to provide a Christmas gift to everyone and cut interest rates. So one of the key things to look at in this unemployment story is forward-looking labour market indicators. Here, CBA have looked at NAB surveys and have looked at recruitment rates as well, and you can also see that general trend coming down gently, and the unemployment rate is gently moving up. It looks quite aggressive in this chart because they've only looked at the last few months, but broadly the unemployment rate is going up. Labour market forward-looking conditions are weakening, and the number of job ads in Sydney and New South Wales is down nearly 25% year on year as well. So the demand-supply balance of labour is starting to get more into equilibrium and more into a healthy level. And you're seeing that in wage pressures as well, where wages aren't rising as much because workers are quickly realizing, oh, hang on, I should be pretty lucky to have a job right now. Even though the labour market's doing really well, it's weakening. The Australian economy is weakening. I really need my job. I'm not going to go ask for that really big wage rise because I can't at the moment. All these things don't sound very good. They actually sound quite ugly. Unemployment rising, Australian economy slowing, and yes, inflation coming down. That's a good news story. But we really need this to happen. It's the only way interest rate cuts will ever come to light. when the Australian economy slows a little bit more than the RBA expect, and that will allow the RBA to come up with the breathing room they need to cut interest rates. So that is CBA's story. You can look at their pricing of interest rates and their expectation of interest rates versus market and the RBA. And in this chart, you can see in this red line here, it comes a little bit before the market forecast. CBA are expecting these rate cuts to happen a bit sooner and are putting their neck out a little bit and coming out with a pretty bold suggestion and haven't changed or pivoted to February 2025, which is where all the other major bank economists are. They're saying it's coming soon, and the Reserve Bank are about to do a giant backflip. There's one more really exciting bit of news in this CBA story. I talked about rate cuts coming in 2024. That is very exciting. But what happens in 2025 in that story that they have? They think all of this is not going to trigger one rate cut. They think it's going to trigger 5 rate cuts. 5 rate cuts. That has a material impact on your mortgage payment, and that can have a material impact on how Australians spend, and it can help promote the economy to grow a little bit more in the year ahead.